Welcome back. We've been discussing the first quarter GDP numbers that have come in below market expectations and the general state of the Indian economy in the global context with Rob Subramanian of Nomura, Pranab Sen, the former chairman of the Statistics Commission, Samiran Chakrabarti of Citi, and Abhishek Upadhyay of ICICI Securities Primary Dealership. Gentlemen, thank you for your patience. Abhishek, there is a bit of a nuanced difference of opinion in terms of how serious the current account deficit problem could be. But what is your estimate of the Reserve Bank's rate hiking cycle? The Fed seems to be hawkish. There could be pressure on the CAD. And therefore, what is the rate cycle? Can it impact growth?
Well, I agree. So CAD is a concern. So in percentage of GDP terms, we may be tracking far lower compared to, say, the taper tantrum period. But absolute CAD at more than $100 billion is going to be challenging to fund in the environment that we are talking about. Of course, it is possible that there is a lot of speculation right now on India getting included in international bond indices. That process could start next year. But this story has played out in the past, hasn't worked out well. So we have to watch that space. I do think RBI needs to be mindful of external sector situation to not overestimate how much leeway they have in framing policy here. Also, inflation is reasonably high. So core inflation at 6%, food inflation showing no clear signs of any sharp deceleration should mean that RBI should try and take real policy rates at least towards zero levels by the end of this fiscal year, and perhaps positive next year. So we continue to assume RBI will front load policy tightening, expect at least 35 basis points rate hike in September, perhaps 50, assuming what Fed does, what ECB does. And at 6% they may pause, but it is likely that there will be some more rate hikes after that also.
Okay, so what's the impact of all that on consumption? I'm coming to that point in a minute, but Samiran, since you spoke about demand, let me scratch that point further. A lot of IT companies are now pulling back their variable pay. Is this urban consumption engine very strong in Q1? Can it continue in the second half?
So, Lata, we just did an analysis of about 3,000 listed companies' wage cost growth data. And what it shows is that while the wage cost growth momentum for IT has slowed down, the non-IT pack, the momentum has improved a little. So what we are hoping for is that while the IT slowdown continues for the next couple of quarters, for rest of the sectors, if this momentum persists for a bit longer, then maybe the overall wage growth momentum is not that badly impacted. So right now, for the first quarter, the overall wage cost growth was 12.7%, which is running much higher than the inflation rate. This is very important because, as we know, rural wage growth momentum has been much weaker at a negative real wage growth. So if urban wage growth momentum also falters, then we would have a significant headwind to consumption. So IT part, yes, there is a decline, but the non-IT, particularly the smaller MSME kind of segments, is where we are seeing some catch up in wage growth, and we hope that continues for the next few quarters.
Okay, but IT is a huge engine of growth. I mean, it's a large employer in India. Dr. Sen, two questions since we're running out of time. One, you referred to the rate hikes. Do you think if things go as high as what Abhishek is saying, 6.25% or thereabouts in terms of interest rates, will that impact consumption so much? After all, this is a country which has seen, 9% and 10% home loan rates forever. So will it really impact consumption so much?
At the moment, no, I don't think so. But, RBI has a bit of a problem on its hands. On one hand, the inflation story demands rate hikes. And given, what's happening in the rest of the world, the rate hikes will have to happen. But the problem that they face is that if they are very aggressive with rate hikes, you could actually see the rupee appreciating against numerous other currencies, which is, again, bad news on the CAD front. Now, balancing that is going to be a trick. And that's what RBI is faced with. So I'm not very sure what they're going to do on this, but it is a problem that they will have to tackle head on.
Okay. Yes, that's true. China actually has been cutting, and India will have to worry about that. But Dr. Sen, anything in these numbers and the past few numbers that worries you about our trend growth? I mean, with a base like that, we should have been 7% and above this year. If we are not managing it this year, subsequent years, will we manage it all?
Yeah, I mean, again, the real question that we need to ask is, where is the weakness? As you said, consumption seems to be coming back fairly strongly, but that consumption seems to get reflected much more in a worsening of the CAD than in the growth.
Okay.
I mean, what we should have wanted is that growth should have been 7.5% and CAD should have been 2.5%.
Fair point. Rob, that's the final question to you. Any comments on India's trend growth? Anything that you're picking up in terms of longer term? Will we get to that coveted 7%, or are there some persistent weaknesses?
I'd say two things, Lata. I think Mr. Sen was very right in terms of what India needs for higher trend growth is a lot more investment, not a lot more consumption. I think the risk of higher consumption is a wider current account deficit. So there needs to be more efforts to promote capex and infrastructure spending, soft and hard. That's not going to be easy in an environment where interest rates are going up. The second thing, which I think is a constraint on higher potential growth, is India's fundamentals, which have deteriorated. If you're looking at the fiscal position, if you look at the current account position, if you look at inflation, that makes it harder to have higher trend growth in the medium term. So I think that's another kind of headwind that needs to be resolved. And to be fair to India, India is by no means the only one facing weaker fundamentals. It's a global situation right now.
Okay. Well, I have the final question. Dr. Sen has already said that he was expecting only a 6.5 odd growth for the current year. Samiran's printed number is 6.7%. Rob, will you be lowering the India forecast?
We're looking at it now. We're currently at 7.2 for this calendar year. The risk is we could potentially lower it.
Abhishek?
We are retaining 7.2%, but clear downside risk to that.
Okay. Gentlemen, thank you very much for joining me. There are two people who are looking at sub 7% growth for the current year and two people who have downside risks to their 7.2% growth. That's a slightly pessimistic interpretation of the GDP numbers, but we have to live with it. Thank you very much for watching this edition of Indianomics. More news and updates lined up for you.